Hello, everyone. Welcome back to the Market Chat. My name is Richard. Joining us today as our guest is Pradeep Bonde, the founder of the Stockbee community. We're going to go really in depth into price action in this one, as well as mindset. And I'm really excited to have him on. He's known throughout the community and has trained a lot of top traders. So Pradeep, thanks so much for being here. Welcome to the show.
Thank you. Thank you for having me.
Yeah, my pleasure. So getting into it, I think we'll start with background, then move on a little bit into mindset. But to start things off, could you talk about kind of your history as a trader, the research you've done, and kind of your journey and progression along the way?
Yeah, so I started trading around 2000. So before getting into trading, I was basically into marketing. I was head of marketing for DHL in India. I was also head of marketing for a FedEx franchise in India. And then my wife got a job in US. She came to US. When she came to US, that was the dot-com boom. And I came to US, but I got a job with a startup. So I was working with a startup. The startup ran out of money. So I came back. When I came back, by the time she had bought some stocks. And when I started looking at those stocks, they were like Juniper, Yahoo, and all these technology stocks. And every day they were going down. Every day they were going down. So I just and I started looking at that account and said, look, and something doesn't make sense because every day those stocks were going down. So that's how I got interested. And then once I got interested, anything which I've done till now in my life, if I get involved in it, there is no halfway through. So I just and I completely got into it, researched the market, started looking at various ideas, and then researched the market a lot. And that is how I found my original ideas and started trading 20 years ago. And I've been doing it very successfully since then, basically.
And you mentioned in our first call that your kind of background on the psychology of side helped you kind of understand and get a step above when learning how to trade. Can you talk about that a little bit?
Yes. So before my when I passed out of it, I'm an MBA from once I did an MBA in marketing. My first job was with the advertising field where I was working on Unilever detergents. And Unilever is heavily into consumer behavior psychology. So in Unilever, it's like everything, they map the consumer's mindset. They know consumer behavior to the in-depth. So if you're handling any Unilever brand, you're supposed to know the psychology of the consumer, how they make decision, what kind of memory they have, how you can affect the memory. So that background helped me a lot when I got into trading, because when you're looking at this trading as a problem, and it's one of the reasons why many of the new traders have a lot of issues with being successful, or even some of the people who tried for a long time, they don't become successful, is this whole thing about active trading. I'm talking about active trading, not about investment. It's a procedural memory game. And procedural memory is a kind of a memory which we have, which is about a process. When we are born, we don't have any procedural memory, and we develop procedural memory. So when a kid is born, he has zero procedural memory. He starts developing procedural memory. Kid doesn't know how to walk. He doesn't know how to brush his teeth. He doesn't know how to eat with a fork. So we learn these memories. And once we learn these memories, they become automatic memories. So after that, you don't really need to relearn them. Once you learn, that's the way the procedural memory works. So it's an implicit memory. That means you're never conscious of that memory. It's the same thing. If you really see a good trader trading, he's not using a conscious memory. He's operating from an implicit memory, or it's a procedural memory. Like I took a trade, and it didn't even take me 1 second to make a decision to buy 3,000 shares of that particular stock based on what I see in a signal, right? And that's procedural memory. It's very difficult for a new person who comes into this field to try and understand that, because he's operating from a rule book, he's operating from a manual. So he's looking at page number 26, trying to figure this out. And it never makes sense to that person, because it's like, can you really learn to drive a car by having a manual and sitting next to it? That's really what it is, right? And it's the same thing as, like, can I say, to give you a very like a real life examples of it is like, look at a sex is a procedural memory, right? You don't sit with the manual while having sex, right?
Mhm.
So it's the same thing when you do trading, and especially active trading, you're operating from procedural memory. And when you operate from procedural memory, if you don't have a correct procedural memory, what happens is it doesn't work. And that's what creates frustration. And that is why you will see that the initially beginning traders have so many issues because they just don't have the procedural memory for a setup. And once you have procedural memory, it's such an easy game, like you can make money at will, basically.
And what's some guidance for people to help build that procedural memory? Is it you actually have to go out there and trade the setup over and over again for a year, or by studying history, can we shorten that learning curve a little bit?
There are many ways to shorten procedural memory. The ways means like basically one of the most important thing about procedural memory is very task specific. Yeah. So I might have a procedural memory for trading my setup, but I don't have a procedural memory for trading other setup, right? So the problem for beginner trader, because they are not really sure whether this idea works or not, they are not focused on one setup, right? Once you get focused on one setup, even if they read a book, supposing they read a book and they see a setup idea, that book doesn't help them in developing procedural memory, because in order to develop procedural memory, how does a kid develop a procedural memory? The parents are watching, right? And he's taking steps. Parents are correcting him, or like he's trying to eat with the fork, and the parents tell him like, don't eat it like that. So there is a feedback, and there is an instant feedback, and then the kid learns. And it is not necessary to develop procedural memory. It doesn't take 1 year, 2 years to develop procedural memory. Procedural memory develops very fast, because if you do not, like if the brain is not designed to, like if it takes too long to develop procedural memory, we will never survive as a human being. Right? It will take so much time. Survival instinct itself makes procedural memory as a fast. So trader who wants to become good trader, if he focuses on procedural memory, first he has to understand procedural memory. A lot of people don't even know procedural memory, right? And I read a lot of books on trading psychology, and none of them really talk about procedural memory. They talk about things which are very different. So once you know that, you can learn procedural memory in few weeks, 2 weeks, 3 weeks. How much time does it take for kids to learn driving? 6 weeks, right?
Makes sense. And throughout your career, who have been your greatest kind of trading influences along the way, and what are some top resources that you really learned from?
No, when I got into trading, I researched everything, right? And it means by personality, I'm a kind of person, if I get into anything, I research it to death. So I researched every trader, okay? It means like you will see on my public blog, I researched everything, and there's a post which attracts a lot of people to my thing, which talks about Dan Zanger's underwear, right? Which is a philosophically looking at, look, how do you, if Dan Zanger is such a successful trader, I want to know everything about him. I want to know about his setup. I want to know what he does. Does he poop at 4 o'clock or 5 o'clock, or what does he do? Because then I can replicate the performance, right? And I'm trying to replicate the performance. So I traded a lot of traders, but there was one particular trader, or there was one particular book, which like in the beginning helped me become quickly profitable. And I think one of the reasons why I still stuck around in trading was because I was so successful, right? Within 1.5 years of starting, there's a book by a trader, he was a hedge fund manager called Mark Butcher, The Hedge Fund Edge. It's a thick book. It's like a 400 pages book. But if you read the book, really in that particular book, there is only just like probably 20 pages which are useful. Rest of the discussion is a lot of discussions about the Austrian economy and deficits and things like that, macroeconomics. But he talks about a specific trading technique in significant details, which talks about how to trade runaway moves. So that was the thing when I read that chapter and when I read that book, many things clicked to me, because I knew, okay, look, this is something which is like the person is not only talking in abstract about setups, he's not only talking about things, but he's actually giving the process. And then I just replicated the process. I replicated And I started trading. I was successful. I simplified, and then research which I was parallelly doing, I found a simpler way of doing what he was trying to do using 6-7 scans. I found a simple scan which is like became the foundation of what I do, which is 4% breakout, and I started using that. Similarly, when I researched all the things which Dan Zanger was doing or what he had said in his interviews and all, he was basically saying that all that he looks at is he looks at stocks which are making a dollar move. Similarly, I was reading a book, Superperformance stocks or something like that, and it said like, stocks which have very high earnings. When the earnings come out, they immediately start going up, or what is called as a post-earning announcement drift or PID.
Right.
So, and it so happened, and sometimes like there is luck involved and there is some serendipity involved. So I was reading the book at 10 o'clock in the night, and that was the chapter I read, and I closed the book, went to sleep. Next day morning, I wake up, and I was reading, this thing is fresh in my mind, and I was going through the newspaper IBD, and they used to publish this table of companies which are announced earnings last night, right? And I was looking at this one company which had announced earnings, USLB was the ticker, and that particular company had come out with earnings and sales in the, I don't remember the exact figure, but they were like high triple-digit sales as well as high triple-digit earnings. And the stock was trading, I mean, it's like I looked at the stock was trading at $3 or $4, something like that. And I said, like, and this book said, like, these stocks tend to double, triple. So let's try out this theory. And if you're a beginner trader, you have no fear, you don't have any concept of risk and all. So I put in 100% of my account in that trading idea. And it started going up. Within 2 weeks, it like almost doubled. Because I had margin, I put in more money. And in 11 weeks, I made more money than any job, like 4 or 5 times more money than a $100,000 job which people were offering me. So I said, like, this looks very easy, right? But so that particular setup became episodic pivot. Episodic pivot is basically, again, I come in from an advertising background, and so whenever you're looking at films or whenever you're looking at TV serials, they always have an episodic pivot, which is the arc of the story changes, right? The arc of the story changes. Similarly, when a stock comes out of big earnings, or it comes out with a news, or it comes out with some sort of a game-changing news, the arc of the story changes. Stock starts going up, and if you can get in right, or if you can understand that episodic pivot, and you get in early, you get 400, 500, 600, 700% moves, or even higher than that. And the advantage of that is you're entering right at the first day. You're entering in, means most of these trades I enter as a OPG order or opening price guarantee order. So I'm in those trades right on day one. So you're not even like looking for a confirmation, because you know the information is a game-changing information.
Right. And taking a step back just a little bit, I want to talk about your overall view of the market and how it works, because I thought this is really cool. When we talked earlier, you mentioned these momentum bursts, which is how the market operates. So could you explain that a little bit? And feel free to share your screen at any time if you want to bring up examples at all.
Yeah. So basically what happens is, or like another basic philosophy behind my trading, everything which I do is based on this structural understanding of the market, right? How does structurally the market operates, or how it's like the physics of the market, in terms of like, if you're looking at physics, you're saying, look, if I have to build a bridge, I need to understand gravity, I need to understand materials, I need to understand a whole host of things, right? Same way, in order to make money in the market, you need to understand the market structure. And there are certain market structures which I trade. One of them is called momentum burst. So momentum burst is like, I can give you an example of, like, say, recent momentum burst, which is happening currently. Let's look at like another, here is Goldman Sachs, right? And it's a chart of Goldman Sachs basically. And if you see here, in 3 days, it has gone up like around probably $13, right? Whenever stocks make a move, they move in momentum burst of 3 to 5 days. And this 3 to 5 days momentum burst move is very common. Like there are 50,000 moves like this happen, right? You will see again here, there's a 5-day momentum burst and the stock made a 14% move. So I was in this trade from this day and today I closed that trade. So this 3 to 5 days momentum burst is a really very common kind of a move in the market. And that's one of the market phenomena. And that's exactly what I'm trying to exploit. So if you take this particular stock, like I would buy on this particular day and I'll keep holding it for 3 to 5 days. And in 3 to 5 days, it makes 17% move. So this is a very high price stocks. High price stocks move in dollar increments. But if you're looking at a very low price stocks, if you're looking at something which is lower price, those stocks in 3 to 5 days make 8 to 40% moves. Okay. And now that kind of a move is very good for a trader, because if I can find 8 to 40% move and they happen every week, and even if the market is going down, you still have some stocks making moves like this, then it's just a question of entering them early on a first day and then taking your profit by third or fourth or fifth day, or trading them, and then you can do hundreds, thousands of trades in a year, and you can make a lot of money. So that's one structure which I trade, which is very common structure in the market. The second structure which I trade is what I talked about, episodic pivot, which is basically whenever there's a big news catalyst, and it doesn't have to be earnings, any news catalyst which comes in, that news catalyst will lead to the stock going up big, right? And if you see last year, SPCE, this stock had a catalyst, which is the government policy changed, like government decided, or the Trump announced that they're going to set up a cyber force or something like that, right? And space force they're going to set up. And that particular day, this stock came into the kind of scan which I use, which was 9.7 million. It was a government policy episodic pivot. That particular arc of the story changed, and then the stock went up 377%, right? And this can be completely a story, or it can be an actual earnings, like if you look at GRWG. Now this GRWG on this particular day, okay, this is where I entered, and I entered on the opening price, means like I had an OPG order or a market on open order for this particular day. On this particular day, this particular stock had earnings, and the earnings was very good. And from that particular day, now the stock has gone up like 400, 500%. It went up 500%, and then subsequently it like went down. But just in 4 days, even from there, in 4 or 5 days, the stock went up 150%. So this particular market phenomena, which is like basically episodic pivot, is very common, and you can find many, many ideas like this. And that's exactly what my friend you referred to, Kristjan Kullamägi, he also trades the same method. Many of the ex-members of my site, like they all trade this idea called episodic pivot, or EP, they call it EP, we call it EP, and which is based on this market phenomena. Similarly, momentum is very well-known market structure, where a stock with an established momentum is going to continue to move in the direction of momentum. So that's another thing which I trade. What you have seen is in the recent years, especially if you look at the last 10 years, many stocks are making moves not based on earnings or sales. Most of the big winners for a year are basically story stocks. Right. These are stocks which are just stories. So stories is another market structure, because market likes stories, right? And it means most of the stocks which are up a lot, if you look at it, then they are not like, they don't have earnings or sales. They just have a story, right? And 2,300%. So this is again a structural phenomenon in the market, or it's a market structure. So how can one identify these story stocks? So that's another thing. Or exhaustion, which is a setup which I trade. There's a trade which I bought yesterday based on exhaustion. So exhaustion is basically whenever a stock is going down, or selling exhaust, and then buyers step in. So this is a stock which I bought yesterday afternoon, and now it's up like an 11%. So that's the signal. So these are all based on market structure, because exhaustion has been around for hundreds of years, or momentum burst has been around for hundreds of years. Story stocks have been around for hundreds of years, right? The nature of the story, it changed, but there has always been story stocks. So my trading or my setups are all based on market structure like this. And these market structures, I've studied them. They've been around for 100 years. They're not going to change. Even though technology has changed, those structures are enduring structure. So if I base my trading based on enduring structure, those things work. As a result, I make money.
Right. And can you talk a little bit about finding these setups beforehand, maybe through screens or some other means, and then also the exact moment that you decide to buy? Because we talked about earlier in our previous call that you're often buying in that first 5-10 minutes of the day where things are moving very quickly. You have to make a split-second decision. So what makes you go ahead and purchase a position and start a position?
See, all these ideas, whatever I discussed till now, like whether it's the momentum burst or episodic pivot or like this particular setup which I bought yesterday, they all come through scans which I've written. Okay, I have scans for these things, right? And I have a process, and the process, these are the tactics which I use. I mean, it's like this is a generic setup. This is not something which is earth-shattering. This is a setup which a lot of traders trade, right?
Yeah.
The only difference between those traders trading this setup and me trading this setup is the set of tactics which I have created, which gives me an edge over some of the traders in terms of when I will enter this trade, right? This particular example, like I entered this trade yesterday between 3:58 and 4 o'clock. So in the last 2 minutes, I bought this particular stock. Now, the advantage of buying that in the last 2 minutes is that I bought a lot of stocks like this yesterday because there are a lot of signals like this yesterday. Many of them gapped up today, right? Now, if I'm trying to enter this today morning, it's a very inefficient way of doing it. Now, doing it in the last 2 minutes, I don't really need a stop, right? I only can put in the stop in the morning today. Mm-hmm. Right, so the risk is lower. So these kind of setups are basically based on a lot of tactical things. Same way when I'm buying momentum burst, if I'm buying a momentum burst, like today in the morning, I bought a momentum burst, or I didn't buy, like, and it was basically an earnings trade. Basically, there's an earnings setup which I trade, which is called NTRT, MTRT, or night time is right time kind of a setup, right? So this is a night time, right time setup. In this particular case, again, the earnings was very good. So based on earnings as a catalyst, I decided to buy this. But many people would buy this after the breakout is visible, right? What time did I buy this stock, or what price did I buy this stock at? I bought this stock at $21.87, which is the opening print, because I had an order which was like a opening price guarantee order. So I got in right at the open. So these tactics, like these setups are generic, right? And anybody can do this. These setup tactics really make a difference in terms of giving you more profits. So similarly, when I'm trading momentum burst, if I'm trading a momentum burst, most of my entries on momentum burst happen in the first 10 minutes. Means I organize my trading to a level where I enter a momentum burst on the first day within 2 to 3% of a move. I'm not really chasing a 8 or 10% breakout, right? And that's what we call OLC, which is organized like crazy to get into these moves fast. And which again brings me back to the same thing which we discussed at the beginning of this call, which is like procedural memory. You can do this if you have procedural memory, right? If you're trying to analyze and do this, you're going to be so slow to try and do it, because this is operating from a completely procedural memory.
And when you're looking at a stock chart, before you're considering an entry, maybe as you're going through your list of ideas, what basically draws your eye? What makes you consider a stock? Is it something about the previous price action being very tight and linear? How do you basically decide whether a setup is worth considering?
This kind of a setup, like in the case of a catalyst kind of a setup, I have a different parameters, which is like for an episodic pivot, there is, but like if I'm just taking a momentum burst, when I'm just taking a momentum burst, it is a function of set of criteria which I use, which is like the short form which we use is 2 Lynch, which is like stock should not be up 2 days in a row. It should have linearity. It should be young in terms of like it's a setup which is not very extended kind of a setup, or a first or second breakout which is happening. Then narrow or negative day before the breakout. So in this particular day, this is a narrow or negative day. Then consolidation quality. So I look at the consolidation quality and what is the quality of consolidation. And then there are parameters for the consolidation quality in terms of what kind of a selling and how many breakouts, breakdowns are there. And then if I'm buying a breakout, I always want it to be buying when it is near the high. But in this case, obviously, this was a pre-planned kind of a trade. So I didn't really, but if I'm looking at, like I bought some trades today, like I bought this IP, right, IP. So this is a trade which I took today, okay? Again, it's the same thing, what I was looking for. It's a very linear setup. Whenever it works very well. It had a very compact kind of action, or the thing was there. And then I saw the breakout and I bought the breakout. In this case, this was a breakout which I came in my scan and I bought it, but it met my 2 Lynch parameters. So whenever I'm buying a momentum burst, it will have a parameters which it needs to meet, which is called 2 Lynch. Whenever I'm buying an episodic pivot kind of a setup, there is a character, there are characters which are characteristic of that, which is called Magna 53 is my way of saying that these are the criteria. And the Magna 53 stands for massive acceleration. Then what's the gap? There has to be a gap, and all those characteristics which I have studied in the past and quantified them, or really qualitative criteria, or it's like a quality control parameter for deciding.
And considering volume, it seems like 9 million shares in a day. That's a very key metric for you. Does that tell you that institutions are involved on that particular trading day?
Yes. Basically, what I did is I did a study of stocks which make a big move of 100% plus, 200% or 300% plus in a year. And what I found in them is that their move starts with a 9 million kind of a volume, right? Even if you see this GRWG, right? This entire move started, and that day 15.9 million shares were traded.
Right.
Okay, and that started off the move basically, right? So after studying hundreds and thousands of these kind of moves, I found that 9 million is the magic number, right? If you get a setup where there is a 9 million breakout or 9 million volume breakout, then that has the legs, because that tells you that this is not somebody who's and even if you look at the SPCE, which I showed you an example, and I marked this volume. If you see this, and I marked this 9.7 million, right? 9.7 million shares traded, right? Before that, it didn't trade those kind of volumes. And then that signal, 400% move happened. Okay. So this 9 million volume is a criteria which I use for finding both either a good earnings breakout, but this is more useful when you have a story stock, because in a good earnings play, you know why you're buying the stock, or you can see this as a sales or it as a earnings, right? But when you have a story, it's a story, right? I mean, there are so many stories. So which story has the legs, or which story is going to make a big move? Those stories, stocks which make the big moves, they have 9 million breakout at their beginning. And many of them have multiple 9 million breakouts at the beginning of their moves. I can show you hundreds of examples of this, like in a TAKT, which is the biggest moving stock.
I think it's TKAT, I believe.
TKAT, right? TKAT. And if you see TKAT, so here in this case of TKAT, what do you see again? And this move started first, there was but here when this move actually started with the big move, that was 67 million volume, right? On this particular day, it was 1.9 million, but 67 million volume. Even in the recent days, there has been stocks which are in the last 1 week itself, there are stocks which have made big moves, and each one of them showed up in a 9 million breakout kind of a thing. So if you see even OCGN, so whenever you see this black line, that's a 9 million breakout, okay? So you'll see at the beginning of these big moves, you will have 9 million kind of a volume. So let's look at say GME. GME is a completely a story stock, right? And it's a story stock. It's based on earnings and sales. I don't think anybody is going to go and buy GME, right? But if you see here, the 9 million breakouts was the signal, or those are the reason why you will get into those stocks. Or even you read that story about this hedge fund manager who blew up, and he bought some of these stocks, right? If you look at some of the stocks which he bought, each one of them, you could see where this move started. Viacom is the stock which he bought, right? Means he didn't buy, but somebody bought it for him. And I don't know anything about Viacom. I don't really believe Viacom is like really, if you go on earnings and all, it's a great stock. But 9 million signal tells you that this stock is likely to make a big move.
So after you see a 9 million share day, that piques your interest, and then you're watching the stock looking for very tight action and looking for that.
I will buy it on the 9 million.
Oh, you'll buy it on
itself. So if I see a stock like this, I have like whenever there's a 9 million breakout, it can be three situations. Okay, it can be one where there is a earnings or a sales as a catalyst, and because of that, it is going up, right? That is what I called as a catalyst or a cat. So it's a cat, right? It's a catalyst. So that's one category of stocks. So I run a 9 million volume screen. Then I put them into three baskets. So one of the baskets is called catalyst. In the catalyst basket, I look at the earnings, I look at the sales, I'll go to Market Smith and check what is the earnings sales. And if I see earnings sales is triple digit or like whatever my criteria is slightly different. I explained to you in our first conversation, like my criteria is 2 quarters back to back 39% sales growth, right? So I'll get into those stocks. Now, if I cannot explain a move with catalyst, then it's a story stock, right? It's like something is happening and there is some reason somebody's buying. Obviously, somebody who was buying was not really like some you or me or a grandma in Florida, right? And this was big cats which were buying. So then I'll go and I call those stocks dogs, which are like basically they are stocks where I don't know what is the story. And then there is a third category where you have a stock which every day trades 9 million kind of shares, right? Those are, we call it liquid lava kind of stocks. Those kind of stocks everyday trade, but they still can make you a lot of money because those kind of stocks, you can do a lot of size, right? So Wells Fargo is an example of that. So Wells Fargo is a very liquid stock, everyday trades. But if there is a good setup and it comes into my 9 million and I see like really good volume, it's not going to be a earth-shattering stock in terms of making a move. Yes, Wells Fargo did make 87% move from there, but I can put in a lot more capital into this. I can go on margin and put in a lot more capital, right? So those are the three things from a 9 million scan. I run a 9 million scan during the day. This all happens during the day. So it's not at the end of the day. Then I look at it, whether there's a catalyst. If it is a catalyst, I'll buy based on a catalyst. If it is a dog, that means it's some story. I'll just like try and research a little bit. Many times I don't understand what the story is. It doesn't matter because there is volume, I'm going to buy it. And it works. Means many of these stocks, I have no idea why they're going up, but they all showed up in my 9 million scan, right? I have absolutely no idea what this company does. Means obviously the name says therapeutic, so it must be doing something, but I cannot explain based on anything which I read that why this stock would go up. But hey, it showed up in my 9 million scan, and now that's all I scare because that tells me that it is likely to make a big move, and it did, right?
And could you talk a little bit about risk management, because that's a very key thing, especially when you're trading these. For instance, this one, maybe you want to get in sub $10, so it's a little bit riskier from the CANSLIM perspective. So can you talk about your risk management system and how you cut losses to make sure that you're keeping risk in check?
So basically, whenever like I'm buying 9 million kind of a thing, if it is the first category, which is the catalyst kind of a thing, then I always have a high conviction, right?
Yeah.
So in this case, if you know that this is going to make a big move, obviously I will risk much bigger amount of money. I don't mind even putting 150% of my account in that particular idea. Like last year, Costly was one example where it was earnings catalyst very clearly. Also, a 9 million breakout on this day, like there was an 18 million shares traded, right? So I had 150% position and that I will take. But if it is a story stocks, okay, there is no way I'm going to put 150% of my account, okay?
Right.
So if it is a story stock, I just, by position sizing, I control my risk. So I'm not going to put more than 10% or 5% of my account on that particular story. So that's really how I manage risk. And as far as like, and if the stock doesn't take off after I enter, I'll be out of it in minutes or hours, right? These kind of stocks where there's a clear catalyst, if they're going to work, they're going to work. Okay,
Right.
They just go. They are not going to come back. If they come back, it's not worth your time living in them. My risk is very low because of my tactics. If I enter a stock like this as an OPG, because I'm entering right at the opening price, to that extent, my risk is lower because many of these earnings breakout, if you try and enter them midday or you try and enter them end of the day or next day, they might be of 30%, 20%. So you're going to be risking much higher. But if you do it the way I do it, your risk is much lower. Similarly, when I'm doing this momentum burst, on momentum burst, my stops are seldom more than 2.5%. That means the 2.5% is really between my entry and stop. Okay. So I'm trying to find as many trades as possible with 2.5% or less risk. And because I do thousands of those kind of trades, I build capital. And once in a while you get because these kind of trades don't show up every day, right? These kind of trades show up with a lesser frequency than a momentum burst. So if I accumulated profit, like see this year has been very good. I have got very good profits till now. So if you like, kind of basically a good EP shows up and which has all the stars lined up in terms of earnings, sales, whatever I look for, I'm willing to put in risk much higher because what I'm looking at is whatever I'm up, I'm going to leverage that to try and be up a lot more by the end of the year. But if I was starting at the beginning of the year, I wouldn't take a big risk, basically. So it's a question of how you are positioned also in terms of how much you're up.
Makes sense. And do you take into account the overall market conditions at all when it comes to your trading?
I trade all the time. I take into consideration the market conditions, but it doesn't stop me because the setup which I have, which is momentum burst and reversal setups which I developed, those setups work in any market conditions. The only difference is going to be you're going to get less number of setups, you're going to get lesser magnitude move. So a momentum burst might end up giving you only 8% in a very choppy market or in a market like current market. But in a good market, the same momentum burst idea might give you 20, 25, 30%. So I trade, but I don't trade blindly in any market conditions. Every day, I have a methodology which is called situational awareness. So situational awareness is aviation terminology because I work for DHL and work for FedEx franchisee. We used to fly planes in India. And whenever you talk to pilot or like wherever before the flight, there's one meeting which is called a situational awareness meeting where they look at what is the weather going to be, what is the landing condition, and then how accordingly, how much fuel to carry or what is the options you're going to. So same way, every day, I create a situational awareness for that particular day. And then the situational awareness, like say, to give you a live example, yesterday morning, I created a situational awareness where I said like in a most likely scenario is going to be at some stage today, we're going to get a reversal in the market. And as a result, there are likely to be a proliferation of reversal setup. So my priority is going to be to trade reversal setups. And so I was ready. So when the reversal setup started showing up in the afternoon, it was like in a kids in a candy store kind of a scenario, and just piled into a bunch of them. And in the first half an hour, just sold all the inventory and just like made tons of money. Now, again, my momentum was like, and in the sense, my situational awareness changed later. So by 10 o'clock, 10:30, I could see that a lot of these things were fading. So I said to my, we have a meetings, Zoom meetings every day, 2-3 times in a day. And I said in the meeting that situational awareness tells me that take your profit, run away with a lot of these moves are going to fade by the end of the day. And a lot of those moves actually ended up fading. So situational awareness is the overall filter to all the trading which I do. And that situational awareness dictates what kind of moves I'm going to target. So currently, because it's a choppy market, I'm still taking trades. I'm still doing momentum burst, but I'm doing them much quicker. I'm taking profit much quicker. I'm putting more tighter stop. Now, if the market condition is different, if there's a 10% correction or 20% correction, and it's a 2-3 months correction, and then the market started going up, I'm not going to take my profit at 8% or 10%, or I'm not going to be just selling my position at third day or second day. I'll hold them for a longer swing. I'll try and find more of these kind of ideas. But currently, those ideas are not really working. Earnings breakouts have not really worked in this particular earnings season. So I'm just hitting singles. I'm hitting a lot of singles. I done a lot of trading in the last 2 weeks, but it's all singles. It's all 5% here, 8% here, $5 here, $7 here. But it all adds up.
Right. And a lot of my viewers on this channel are more, they kind of have CANSLIM backgrounds for the most part. What kind of misconceptions do you think people who basically learned that style first have when it comes to price action and reading the market?
I think my frank opinion is that CANSLIM has become a cult. Okay? A lot of people who get into CANSLIM, they will benefit a lot. They'll benefit a lot and they'll become more profitable if they question some of the assumptions behind CANSLIM, because those assumptions are no more true, many of them, right? Like one of them assumptions, which is in CANSLIM, is that companies need to be profitable for them to make a big move, right? Which is like foundation of the 25% earnings growth or EPS ratings or whatever kind of thing. I will show you hundreds of, I will show you research, and I shared that with you, that only 12% of the companies last year, which were the biggest winner for the year, had any kind of sales or earnings. 88% of the companies were just like story stocks, right? And this is not true of this year. There are like a lot more of these. So the CANSLIM, obviously, that's where most retail traders start, or many of the retail traders, they are like completely enamored by CANSLIM, and which is not a wrong methodology. But when William O'Neill developed CANSLIM, and between that and today's market, even if William O'Neill himself was trading CANSLIM, he will not trade CANSLIM the way people blindly use it, right? So that's the difference in terms of CANSLIM. Is CANSLIM a good methodology for a beginning trader to use? Yes, I also used to use CANSLIM. I used to read IBD every day. I used to take notes. I used to believe in all those things. But I question all those assumptions, and I still question many of the assumptions. If you question the assumptions, you will realize there are better ways to trade those same stocks. And you can actually make more profit if you question the assumptions.
And one of those assumptions that a lot of people have is those earnings. You need to have earnings to make a big move. And from what we talked about earlier, it seems like sales growth is a bigger factor.
Sales growth is the biggest driver of big moves, right? And if you look at the stocks which make the biggest moves, and I shared with you the database also, and I shared with you the kind of screening which I do based on that research, is what I have found, and which is not something which is a secret. I think there's a Morgan Stanley research which I saw which says exactly the same thing, that it is the sales growth or the revenue growth is much important or more important than actual earnings. And you will see examples after examples of those kind of situations where companies had back-to-back sales growth of 39% plus, multiple quarters in a row, and they have no profitability. And those companies make such a big moves. So if you change your CANSLIM approach to those who are blindly following CANSLIM and do a different way of doing the same thing, which is growth stocks, right? Today, growth stocks, no more like profitability is not important for a growth stock to work. Really, that's the case.
Yeah, I think that's good advice in general. Obviously, it provides a good foundation, but questioning every single component and following it to a T isn't the right way to go. Do your own studies and find what works for you and build your own edge. I think that makes a ton of sense.
Yeah, that makes sense. Also, like a lot of these things, because people believe in a lot of these things blindly, or other people tell them to believe in it, it's become like a lot more cultish. You talk to a CANSLIM trader and you start questioning some of their assumptions, and they just start either arguing with you without realizing, or like they're using things which may not be necessary, or there might be much better way of making money. That brings me to another topic which I think is dear to my heart, because I deal with a lot of traders. Every day I'm talking to traders. Like my site, I have traders, and most of the traders who are there on my site, old timers, they're very successful. So a bunch of very successful traders, and I interact with them. And I have studied successful traders because they're my friends, and I talk to them on a daily basis and talk to them. And there are people who are like big hitters, many of them big hitters than people worship some of these people who they think are big hitters. I've seen big hitters who are like even bigger hitters than these people whom they worship. And I've seen and studied these people, and I've discipline is what people tell you is the success or the secret to being successful in trading. But most of these people, it's not discipline what has made them successful. What has made them successful is they are creative, they're innovative, and they have leadership skills. So they can fix their trading problem. So creativity and innovation is more important than being a disciplined trader, according to me, because if you are creative and innovative, you'll find solutions, you'll find setups ideas, you'll find entry techniques, you'll find tactics, which will be completely different if you're just being very disciplined.
Makes sense. And how much has your own trading changed over the past 5 years? Have you just adapted to changing environments and change your tactics a little bit, or is it a completely different shift?
There are no major setups. Like I've been trading for 20 years. I've been trading momentum burst. Okay.
Yeah.
For 20 years, I've been trading episodic pivots. Right. The only thing which I continue to research setups, and because I interact with a lot of successful traders, we share ideas, we exchange ideas. But how I was trading 20 years ago, I'm not trading the same way. I'm not trading, I'm not looking for home runs. Okay, I used to look for home runs, to continuously look for home runs. I'm not looking for home runs. Means I'm looking for home runs in episodic pivot, but my profitability at the end of the year is not dependent. If there is no home run, I can still make money. So that's the big difference which I have done in terms of how I approach this trading thing. And because I do it for a living, right? And I do it for a living, like I have to pay my bills, I have to pay my mortgage from trading profits. So I become like, and I have found certain tactics which have become very useful. Selling into strength is one of them, which is basically what has made a lot of difference. And one of the reason why, like many people come to my site, they are not successful, they've been struggling, or like they're not doing well. They know how to find a setup, they know how to enter, right? But they don't have this concept of what we call selling into strength or peeling of position. So these tactics is what I have learned. Some of them I developed, some of them I learned through other people. Like we have a very successful trader on our site who does very well. And I learned from him this technique of peeling a position, taking a larger position. So I take a larger position nowadays. Like my swing trades are not like risking 5%, 10% of my capital on a swing. My swing trades are typically 60, 70% of my capital in one trade kind of a thing. We take a position, we immediately peel off, start peeling it off. So if I buy 3,000 shares, and if it goes up for $5 or $5, I'm going to like, and I start uploading some of it. I'll upload more. So I'm offloading. What it does is it changes the profit profile of that trade, because somebody who's going to be holding up, he might end up like giving up so much of open profit. But because you're doing it in an incremental manner, you're selling, you're keeping profit. On the rest of the position, we use a trailing stop. If you use a trailing stop, then there's no way, unless it gaps down next day, you're going to be like with a loss-making trade. So those are some of the tactical changes which I've done. That's one, which is selling into strength is one. The second big tactical change which I've done is what we call fee or find and enter early. Right. So find and enter early has become very important for trading breakouts. When I used to trade breakout 20 years ago or 15 years ago, I used to run my scans, look at those breakouts in the night, and enter them next day, and they still used to work. Okay. Today, if there is a good breakout, that breakout is going to become 15-20% move in the day one itself. So it's become so critical to get into a breakout, not only on the first day, but to get into it in the first 15 minutes or 20 minutes. Because if you get into a breakout, it's just starting, it's 2%, you get in, you might end up with 20% breakout by the end of the day. So your day one itself profit, which I was not capturing, I'm capturing. So that's an example of a tactics which I'm using. Then there's a setup which we're not really discussed till now, which is my anticipation setup, which is like an anticipation. We call it ANTS. That setup is something which I developed consciously, because in that setup, I'm not really entering with a confirmation. I'm entering before the breakout happens. Because you enter before the breakout happens, your risk profile of the trade is very different. The breakout is successful. You're already in that particular trade. And the anticipation method which I trade, the setup which I trade, the tactical entry in that particular thing makes so much difference, because the anticipation setups which I find are the same setups which other people find, right? Or many of the other people find, because it's not a secret what I do. But they enter it next day morning. They're waiting for a confirmation. Or sometimes the anticipation setups which I identify and enter, and I always enter anticipation setup between 3:58 and 4 o'clock, which is the tactics basically. So when I enter between 3:58 and 4 o'clock, those same setups might be in some newsletter. There might be somebody who might tweet saying, look, and that person has 100,000 followers. So next day morning he tweets, but by that time I'm already in that trade. So people are buying it. And many times what happens is you can just sell to those willing buyers in the morning who are buying it or chasing it. And sometimes they gap up, like you buy it in 3:58, 4 o'clock, and next day you see 10% gap. So you take your profit and run.
Right. But on an anticipation breakout, the next day it could gap down, obviously. At that point, you just cut at the open?
I will cut the losses. And I've been doing this for 8 years. I've been trading anticipation setup, okay? This is a very common question I get, like what happens if it gaps down? Last year, I must have done probably 250, 300 anticipations trade. I remember only 2 times it gapped down where like it was beyond my risk profile kind of a thing. This year, I had 1 gap down. So if you're operating with stocks which are in a very tight consolidation and in a very, they're not likely to gap down. The profile of like the stock selection is key. They have a very low probability of gap down. But do gap downs happen? Yes, I'm out of it. Same way, if the trade doesn't work in first 15 minutes, I'm out of that.
Move on. Gotcha. Would you mind going through some charts and kind of talking through how you look at a particular stock and maybe find a setup that you might be interested in and talk about why that is a good setup?
Yeah, I can talk about like basically. So some of the examples of like trades which let's look at like obviously I did this particular thing, but like let's look at FTCH. Okay, again, this is a trade which I did last year also, like, and I did it 2 to 3 times basically. So here again, you will see that like what attracted me to do this particular trade was here 9 million breakout. Okay. 23.5 million shares traded on this particular day. There was a catalyst. I think Baba took a stake or something was the catalyst. Plus, this stock has this thing, and then it went up a lot after that. The last one didn't work as well as this. Square, again, here like basically this was like 27 million shares traded. This was the earnings, but before that also it had an earnings breakout. And this is where like it had earnings breakout kind of a thing, okay? And that was like 16 million, and then it kept on going up and going up. So this is like the kind of episodic pivot kind of a trade, okay? But the short-term swing trades in a week, hundreds of them, okay? Goldman Sachs is an example of a kind of a trade. And I always like within these kind of stocks, I trade higher price stocks. I really don't trade very low price stocks. Most of the stocks which I trade are $100 plus kind of a thing. So here, Goldman Sachs, I bought it like it was also an anticipation kind of a setup. Here I bought it, and now it has gone up for 3 days. If you're looking for like say BLK, BlackRock, I think. Yeah. So here, BlackRock, I traded multiple times. I entered this on this particular day, right? And then held it. And then again here, like it is a breakout. So those are the kind of trades which I do, high price stocks, because I'm looking at a dollar move, not really a percentage move. It allows you to move bigger size. You can put in bigger size. So this is a good example of a momentum burst kind of a trade.
Before you move on from this one, so BLK was that first buy? Was that an anticipation setup there on the upside reversal?
No, it's a dollar breakout kind of a thing.
It's dollar breakout.
Dollar breakout, right?
We haven't talked about that yet. Would you mind talking about that setup?
Dollar breakout is like in a year also, like, and if you see this particular stock, okay, now this stock is not in my 4% breakout scan. It is a dollar breakout, right? The stock is actually having a range expansion, but on that particular day, it was only up 1.31% in percentage terms, right? In dollar terms, it was up $10.
Right.
So I scan for a dollar breakout where I look for a stock which is up more than 90 cents for a day, provided that its previous day's range was less than 9, or it was not up that much, kind of a thing. Okay, so in this particular case, so what happens, the advantage of this, when I said like, I take a lot of my trades and where my stop loss is 2.5% or less, how do I get 2.5% or less stop? If a stock is up 1.31, my stop is going to be low of the day, kind of a thing, right? And if I enter it early, because if it showed up in a scan when it was up only $4 or $5, if I enter it early, my stop is going to be even closer. And then it just like in a works, 3-4 days, I will exit the trade on a third day, fourth day. Sometimes in this market, many times I exited trade same day because you see momentum going away just in one day. So that's the kind of trade which I do. So crowd, which is like basically you'll see multiple of these momentum burst here. The stock I traded multiple times last year. So this is momentum burst again, $27 move. And the beauty of this kind of setups is always that they are up less than 2% or 2.5% on the breakout day itself. So for a very little risk, you can get a lot more dollars. So I do size in this kind of trades. So I'll have a big size in this kind of trades. So many of these, so many times, like even SQ for that matter here. So here, because that's like, and if you look at SQ again, 2.85% move, right? And these are all like, how do I find them? I scan for this. Basically, I scan for them. I run a scan called combination scan, which is a combination of 4% plus dollar breakout. And I start running it as soon as the market opens. And most of the days, okay, I'm in fully invested in the first 10 or 15 minutes. Okay. Wow. And most of the time, I make my money in the first 1 hour, and the rest of the day, just managing those positions.
Right. For the people who do use TC2000, would you mind showing your scan codes, or would you rather not show that?
It doesn't matter. Even if they look at the scan codes, like unless they have procedural memory, right, I don't think they'll be able to make money. So these are basically, even if you look at the scan codes, it's a little bit complicated, like sounds complicated, but essentially two parts to this thing. One is I'm looking for a stock which is up 90 cents from the opening price, right? So I'm looking for a stock which is up 90 cents from the opening price. And the second part is basically I'm looking for a 4% breakout. So when you have a smaller cap, you have a mid cap or stocks with a lot of momentum, they break out with a lot of force. And if you try and buy them with a very small, like pocket pivot kind of thing, they don't really do as well as if you buy a breakout on them, because that's the nature of their move. So in those cases, basically the second part will find those trades. And then the third part of this equation is really the stock needs to close near the high. So it has to close within, means like 0.7. If it is 1, that means it closes exactly at high. So it just like it closes within 70% of the high, kind of a thing. Okay. And I run this scan, and there is a bearish equivalent of that. So I do shorting also. If there is a short, I will find a short. And then once I go through this particular thing, like say, here is what, like today, these are all the ideas which I shortlisted. Obviously, I'm not in all of them. I'm in many of them, but I'm not in all of them, which meet my criteria. So these are all from today, right? So these all came in my scan, and then I hand selected these breakouts as the good ideas. And many of these I selected right in the morning itself. And as you can see, all of them are like just a momentum burst. And so that's on the long side. On the short side, I have a slightly different setup on the short side. We really not discuss the short side setup, but I have a setup called weak structure short, which is basically looking for a stock which has extremely weak structure. So something like this will be an example of a weak structure where there's a waterfall decline, and then there is just 1 day bounce, and immediately the stock starts to go down. So those are stocks which are extremely weak. Right. And the reason why they're extremely weak is the institutions or whoever is holding them, they're just dumping it. And you'll see weak structure stocks, they will just like day in and day out, they just don't even have a positive day. They just keep going down. So those are the things which are easier. I always find weak structure shorts easier to trade because they just have 1 bounce or 2 bounce. So I need to look at a stock which has less than 3 days consolidation or a bounce. And it has to be a very weak bounce. I don't want really a strong bounce of 10% or 20%. I just want a weak bounce, and then they continue down basically. So this is like momentum burst. This is all momentum burst. Then I run 9 million scan. So 9 million is slightly evolved. 180 stocks are showing up today. So I'll go through this, I research them. And if I see something which has a catalyst, then it will go in the catalyst column. If it is something which is basically just a storage stock, it will go in a storage stock. Or if it is a liquid lava kind of situation, then I'll take it just as a liquid lava. So here is an example of liquid lava. I didn't take this trade that day because I had a Goldman Sachs as the option to this trade. Yep. This was a trade which was like, because in Goldman Sachs, I can put in a lot more money. That was the only reason. But this would show in liquid lava kind of a situation, there. So this is as far as 9 million is concerned. Then I run an anticipation scan. There are a bunch of anticipation scans which I run. Primarily looking for what we called as like very tight action. TTT, which is the setup which people know on my side by, where I'm looking for a very tight action 3 days in a row. So not many of those setups were there today. But like something like this, it's not a completely formed setup. It might require 1 or 2 more days or OTs, or like this looked at that stage when I put it there, looked good, but it's no more. But none of these I bought. So that's essentially the process loop. I have a reversal scan. The reversal scan today, again, like in reversal scan, you're not going to find anything much because everything which had to reversed yesterday. But here is an example of a reversal scan. So it gives me a signal on this day and I buy it. It gave a signal on the stock here, and then like it went up for 12% here. Very good trade basically, or Z, right? Zillow, which was this thing, or Zoom was one good this thing. Obviously it faded, but in the morning there's a profit, a lot of profit in that particular trade. Or even if you look at the indexes itself, TNA or Labu. So there are so many. There are like, yesterday when I ran the scan, there were 500 stocks. So, I had so many trades today morning. First thing I was just selling.
And as in terms of execution, are you mostly looking at daily charts, or are you going intraday as well for a little bit more precision?
I'm not looking at intraday chart to make any of these decisions. I'm not really looking at any intraday chart to make any decision. I buy. If I have like anticipation setup, and once I've done my work and I put it on my thing, I don't need to even look at a chart to make a buy decision because I already looked at the chart, right? And I just buy it based on the research which I've done, basically. So I don't really look at intraday. I do have a method which I trade intraday. If I cannot make money and the market really is very difficult and I still need to make money, then I'll go and do intraday trades. But that's not my style. That's not something which I enjoy. Intraday trading is very stressful, requires you to sit there. I don't like to work hard. I like to make easy money. I want to find free money. So I don't do day trading. I do swing trading. Most of it in first half an hour, 1 hour, and rest of it between 3:30 and 4 o'clock.
Makes sense. And in terms of stock selection and putting stocks in your universe, can you talk about the different buckets that you use? We talked about looking for sales growth, 39% a while ago, but maybe you could bring up MarketSmith and show your screen.
Yeah, I can bring in MarketSmith basically. But before I get into MarketSmith, I might have to explain a little bit because otherwise it's a little bit tricky for somebody who doesn't know to really just expose them to the bucket, they'll not know what we're talking about, right?
Right.
So I'll just like kind of pull this thing application here. And so let's look at the buckets, which is like basically, so what I have is 3 buckets, okay? I have bucket 0, I have bucket 1, and I have say bucket 2. Okay, now each of these bucket is essentially, this is like my version of growth stocks, finding growth stocks. So in the bucket 0, what I have is, in the bucket 0, I have stocks which have IPO'd in the last 10 years or less, or they were incorporated last 10 years or less, because of whatever reason. That's how the database is built in MarketSmith, right? And they have 25 million plus sales or revenue, and last 2 quarters in a row, that 39% plus sales. Okay, so essentially these are young companies, and they have, and also there is another criteria, their capitalization cap is below 10 billion, right? Why is this important? Because if you look at, say, let's look at something like Fastly, right? So when Fastly currently has a capitalization of 6.6 billion, right? When it came in here and it made this kind of a move, right? It was still below 10 billion or something, right? And at this stage, probably it had a capitalization of around 3 billion. Now, these kind of stocks can make big explosive move. Or like if you look at GRWG, when I saw GRWG, as of now, after making such a big move, has 2.1 billion capitalization. But when I entered on that particular day, and it's gone up 400% approximately. So the capitalization was less than 500 million, right?
Right.
So these young companies are the one which are capable of making big explosive moves. If you're looking at like even LVGO, which was a stock which is no more trading, but it was below 10 billion capitalization. And those stocks can make big moves. Even in the story stocks, when you're looking for really good stories, there are stories where the capitalization is low going to be, right? Now, that's one. But even the larger stocks can make move. Like Tesla is a very large stock, but it still can make a move, right? So the bucket 1 is basically a bucket where I have stocks which are meeting the same criteria as above, but the 10-year is not there. So they will have 39% plus sales growth 2 quarters in a row, or 1 quarter of triple-digit sales growth. And capitalization criteria is not there. So I basically, this is my priority number 1. The priority is 0 bucket is number 1 priority. That's an idea where I find more explosive. The second priority is what? And the second bucket is really, it's more like a CANSLIM kind of a thing, where I'm looking for a stock which might have a profitability 2 quarters in a row. Everything which I do, I look for a 2 quarters in a row. Single quarter is not really sufficient enough to make a decision. So the buckets, if you want to see in MarketSmith.
But 1 quarter of triple-digit sales, that is enough for you to.
Yeah, that might be enough. That might be enough for sales. Yes, sometimes, but always like based on what I studied, it's always going to be 2 quarters of sales growth. So this is the bucket 0, right? If I open the edit, so this is like sales percent change quarter 39. Now the way the database is built, you can't really find back-to-back quarters. So sales. So average sales of last 2 quarters is greater than 39%. So that way you're ensuring that it will have like 39% sales for the other quarter also, or at least that is the way, that's the only way you can do it in this particular thing. So these are like all criteria. Incorporation date will be like 2010 onward. IPO date might be 2010. There's a marginal difference in IBD for whatever reason, but IPO date 2010, right? So this is bucket 0. Bucket 1 is a bucket where like I'm looking at similar thing, 39%, but I'm not looking at those incorporation dates. I'm not looking at the capitalization. So this is a larger list, right? And then the bucket 2. So this is where like in bucket 1, if you see, sometimes you can have like a very large sales of 99% plus triple-digit sales, and they don't have 2 quarters. So I'll take that also. So that's why there is a bucket 1. And subcategory bucket 2. So in this, I'm looking at EPS percentage change of 39% plus, back to back 2 quarters, and sales percentage for last 2 quarters or should be 20%.
Right.
So that's really what it is. Now, once I get them here, I make them mutually exclusive.
Mm-hmm.
So in bucket 0, there are only bucket 0 candidate, or bucket 1 now candidates are like stocks which are not in the bucket 0.
Mm-hmm.
Right? And bucket 2 is basically something which is not in bucket 0 and bucket 1. That is bucket 2. Now on this particular kind of a list, I'm always looking at for finding a bigger trade. This is for finding a magnitude trade, right? I'm not really interested. For finding momentum burst, I don't need buckets. I don't really care. I don't know what business they are in. Doesn't matter, right? You're just looking at it to 40% move. But if I'm looking for something to hold longer term, or if I'm looking for something which is the potential to make a bigger move, then there are 141 stocks. So every day morning, I go through these 141 stocks and see if something is setting up nicely or something is like really in a consolidation. And then I don't buy on a breakout.
Mm-hmm.
I buy in consolidation. That's what we call BIC, which is buy in consolidation. So I'll buy them in consolidation. Unfortunately, currently, there are no stocks which are like really in consolidation or good consolidation. Mm-hmm. But last year, there were like a bunch of stocks from here, which I bought when they were in consolidation, and then they went up, kind of a thing. So that's the buckets. Those buckets are basically for, because amongst my members of my side, there are people who are full-time traders, mm-hmm. and then there are these working people. These working people, they cannot do the kind of trading which we do. They aspire for it, but their job doesn't allow. Last 1 year they could do because they're just basically sitting at home and pretending to work. So they were doing active trading, right? But so these working people, they always come to me and saying, look, I'm a working person. I cannot do what you're doing. You're making money. I want to make money. So I really use this method for them to find trades.
Yeah.
And these are trades which are more likely to be longer duration, few weeks, few months kind of a thing. Plus, they're not taking risk because I can buy a storage stock, mm-hmm. because I can babysit it. Mm-hmm. Can a working person buy a storage stock?
Not really.
As it is, he's got a job. He buys a storage stocks. He loses money. He'll have to work forever. So storage stocks, you cannot really like trade them. You cannot really, working people buying storage stocks is not my recommendation. Unless you can babysit those stocks and you're really present and you can like take evasive action, because these stories can flame out in 1 day also, right? So this buckets is really for working people. That's really what I do for working people. Whenever somebody comes in and says, yeah, I'm a working person, what do you suggest? I tell them focus on buckets, focus on 9 million, because that's the 2 places where you're going to get trades which are going to be longer duration, longer magnitude. And you cannot really do the kind of trading which we do, mm-hmm. because it requires you to be there, really take profit. Not really, these are not the kind of 3 to 5 days swing trades. Unless you're fully focused on it and you're there, it's very difficult.
Makes sense. And how do you decide whether it's going to be a 3-day trade or a 5-day trade? You mentioned it's a choppier environment now, so you're probably taking profits a little bit earlier. But in general, is it just a feel thing when it comes to the market conditions, or is it based on the price action?
It's basically whenever you're dealing with a small cap kind of a stock. Yeah. When you're looking at a lower price stocks or smaller, or like really they tend to move in 3 days increment, and in 3 days they'll make 30, 40, or like some crazy moves kind of a thing, right? And as a rocket made like some 100% moves in 2 days. But when you're dealing with higher price stocks, whenever you're dealing with higher price stocks, you're dealing with a different animal. So if I'm dealing with, like, say, something which is like Goldman Sachs, or if I'm dealing with BlackRock, or many of these very high price stocks, which I called as like, we call them FHP, which is focused on high price stocks, say AutoZone for that matter. In AutoZones, there is no point in taking your profit in 3 days, because the swings on these higher price stocks tend to last for 5 to 10 days, right? Because they are lower beta, or they are not as fast moving as this thing. Many people don't even trade high price stock because they're so scared of high price stock. Mm-hmm. So say SAM and all these are like longer duration. While if it is a really one of those hot story stocks, or it's one of those really very this thing, it's just going to work for 3 to 5 days. In 3 to 5 days, it will make such a big move and then just flame out. While restoration hardware, 8 days, 10 days. So it's price dependent, basically.
And what does the stock look like before momentum burst? Is it a really tight consolidation, like right here with RH?
Yes. So good example of like that will be from the stocks which I selected today. So whenever I'm looking at a momentum burst kind of a thing, I have a criteria which it has to meet. But a good momentum burst can also start as a this thing. But like this is the kind of a momentum burst which is a good momentum burst because it had very orderly consolidation. The criteria which we use, two Lynch, which is just a checklist, basically, is really that. Look at it, it needs to meet two Lynch. It has to have consolidation. During the consolidation, it should not have negative days, too many negative days, or big breakdowns, and should have a series of narrow range days. So volume should be low, preferably. So that is what I'm looking for before the momentum burst, basically.
So a little bit similar to Mark Minervini's VCP, the last contraction should be very tight ranges, low volume, that type of thing.
Yes, but the only difference between like Mark Minervini and my approach is like Mark will not buy a stock which is like near 52-week low or something which is in a downtrend kind of a thing. His trend template is going to only select stocks which meet certain criteria. So he's basically looking for a predetermined momentum stock. On a momentum stock, is looking for a VCP, right? Volatility contraction patterns. While I'm perfectly happy to buy a stock near a 52-week low because they work very well. They work, in fact, they work as well as a momentum burst here works as well as you buy it near the low also. Because you're just looking for 8 to 40% move in 3 to 5 days. Yeah. So that's the difference between what he does and also the amount of effort which he puts in. He puts in hours trying to identify these things while I scan differently so I can find them much quicker without going through thousands of charts. Like I'm scanning for certain things, anticipation. I'm scanning for a particular kind of a pattern. The scan spits out only 100 stocks. So I'm not going through 1,400, 1,500 stocks.
All right, Pradeep, thanks so much for showing us your setups and explaining how you view the markets and everything. I always like to end it with one last question. What can new traders do to shorten their learning curves and try to get profitable and achieve super performance as quickly as possible?
Okay. There are a couple of things which new traders can do or struggling traders can do. Number one is to find some market structure which is so inherent that if you base your trading on it, you're likely to be profitable. Right. Second is knowing market structure or knowing setups is not going to make you profitable. What makes you profitable is your ability to extract money from that particular setup, which involves process, which involves really understanding process. The third thing, which is an advice which I give a lot of traders, new traders, is find somebody who is very successful. Okay, find somebody who is successful or talk to people who are very successful and try and basically mimic their trading in the beginning. Don't try and reinvent the wheel because you can shorten your curve a lot. Like I shortened my curve because I found Mark Butcher and his methodology, and I just like took that and then make sure that it was working for him. I made it work for me, right? So if you can find a very successful, like go to Kristjan Kullamägi, his site is free. Is like try and understand what he's doing and then try and make it work for you, because then you will save years of effort because he's already put in the effort. He knows what he's doing. He's made the kind of money which you can see. So that's important. And talk to people who are real traders. Talk to people who are real traders. You will learn more if you talk to real traders, interact with real traders in 10 days than you learn by reading thousands of books and doing thousands of courses and spending thousands of dollars on courses. If you can talk to a real trader or find real traders and talk to them and see what really they're doing, you can reduce your learning curve significantly.
Fantastic. Pradeep, thank you so much for your time. I'll have the links down below to your Twitter as well as Stockbee. Is there any other ways that people can reach out to you and connect with you and learn more about your methods?
Yeah, I'm like people send me, the easiest way is to send an email to me. I respond most emails. I respond within 24 hours. There are hundreds of people who contact me. As long as it's a thing where I have an expertise, I can answer, I'll answer. If I cannot answer your question, I know many traders. I can put you in touch with some other traders, or I can ask them and tell you, okay, look, and this is what he's saying, or this is the problem. People come to me with a lot of trading problems nowadays because of word of mouth, right? I always, then if I don't know the answer, I can find the answer because I can call, pick up the phone and talk to somebody who's a better trader than me and ask them to look at it. What do you think is the possible solution?
Perfect. Yeah, so go ahead, check out the links down below in the description. Pradeep, thanks again for sharing your time and showing us how you approach the markets. We really appreciate it. For everybody watching, thanks so much for tuning in. If you enjoyed, please go and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos.